Let's bring in Independent Advisor Alliance Chief Investment Officer Chris Zaccarelli. And Chris, good morning. So your reaction so far to earnings? We're just getting PepsiCo, and obviously we're going to be getting some inflation data next week.
Good morning. Yes, earnings has been a really interesting period this time, whereas last year we saw almost solid beats across the board. This year it's been a little bit mixed. You've seen, really good performance from certain technology stocks, such as Netflix and others. And then you've seen, Tesla and those technology stocks not do as well. So it's been a mixed bag for technology. Same thing across other sectors, whether it's in financials or consumer staples like we saw this morning. The market's really expecting a lot. You saw Pepsi this morning beat on earnings, but miss on revenues. Looks like the stock's down a little bit in the pre-market. We'll see what happens throughout the rest of the day. But ultimately, the market's really expecting a lot. They want to see earnings beats. They want to see revenue beats. After last year's big run, the market's not being quite as forgiving as it was last year.
Yeah, well, certainly the market is, there's a lot on the horizon. We're expecting rate cuts, and then we're probably not going to be getting them. We're talking at the best case March, but probably June, based on what we heard from this past Fed meeting. Chris, let's talk about inflation. I mentioned it. We've got CPI Tuesday. PPI comes out Friday. Chris, what are you expecting? Because John Lansky's on set as well. I'm going to bring him in, but go ahead.
Okay. Yeah, as far as the inflation data goes, whether it's PPI or CPI, clearly the trend has been lower. We peaked above 9% in CPI. We've been coming down ever since. Last month, we saw a reading of 3.9% for the core reading. Our expectations is that core will continue to come lower. Maybe it'll be 3.8, 3.7. We'll see next Tuesday. However, it's always been a noisy, a bumpy series. So with consumer CPI, with consumer price index, we wouldn't surprise us if it potentially stayed the same or went a little bit higher. However, I think, if that were to happen, I think the market wouldn't like that. So if you can see CPI keep coming down, which is our base case, I think you'll see the market continue to grind higher. However, if we see a hotter than expected print, to your point, that'll mean probably less rate cuts will be priced in, and potentially that could be a little bit of a headwind for the market.
That's going to be interesting. John, jump in here.
Well, I think Chris is right, for the month of January as far as the CPI is concerned, but I'm worried about what lies ahead, especially since we see signs of wage growth gaining speed. The average hourly wage, after rising 4.3% in December, moved up to 4.5% in January. And this, warns that you're going to have a difficult time to continue to extend this slowdown by core inflation unless you begin to see a deceleration by wage growth from a now 4.5% rate to something eventually approaching 3%. I'm less optimistic about inflation, and that means interest rates remain high. And if interest rates remain high, you're going to have difficulty keeping the market PE ratios where they currently reside.
Yeah, those are some really interesting points. And I think when you look at inflation, you're looking at both goods inflation as well as services inflation. And to your point, if you look at wages going higher, that's going to put upward pressure on services inflation. So as we look at the two components, goods inflation has been coming down, services has been coming down just a little bit slower. And if we do get stuck well above that 2% range, let's say we come down from close to 4%, a little bit closer to 3%, the Fed has been telling us they want to get down to 2%. They're not going to accept 3%. So absolutely, I completely agree. I think if inflation stays high, it gets a little bit stuck above 3%, we could see higher rates for longer and less rate cuts potentially, or at least those rate cuts pushed off into the future. What I would say is, the market has continued to do pretty well under a relatively high inflation and high rate environment. It seems like a lot of what's pushing the market forward is just continued earnings, continued consumer spending. If that can continue, even if interest rates are at their current levels, I think the market can go higher. But absolutely, if the interest rate cuts don't come at all this year, and some of that is priced into the market, clearly that's a disappointment.
That would be, and that's when you like to see kind of that March to June quarter, I think, is where you're really going to start to see that fear possibly play out. We always talk about places where you can actually buy stocks on the cheap. There might be a moment this year. Chris Zaccarelli. Chris, thank you for being here. We appreciate it.
Thanks for having me back.